how and when should we declare the depreciation of the property in the income report?
Okay. Hi, Rosie. Thank you
Yeah.
for the introduction. And regarding the first question, is depreciation is always what is called a tax shelter and is used whenever there is income produced. So if your property is producing income, meaning you receive rental income, you are entitled to the depreciation. So this depreciation is basically the amortization of the value of the property for your books. It only happens in the books, but it doesn't happen anywhere else because your property actually increases in value here in the USA. So what the Internal Revenue Code is trying to give you or help you is to reduce a piece of the property value or the property price every year. And this is what is called straight line depreciation. Straight line depreciation, you divide the amount of the property what you purchase for, um, divided into the number of years of depreciation, that in this case is 27.5. That is the rate for a period. So that number you will use for every year to reduce your expenses. That is entirely deducted from the income. Now, there is also another method of depreciation if you want to do one-time depreciation. The Internal Revenue Code allows you that when there is a limit of $5 million. There is also another method of depreciation. You can use an accelerated method of depreciation. The IRS really doesn't pay too much attention to the method of depreciation, but once you select it at the beginning of the depreciation period, you cannot change it. Now, it sounds very good, but it's too good to be true because when you sell the property, you have to recapture that depreciation. It means that all the depreciation that you have deducted from the income, you have to take it back and pay 25% of taxes, unless, of course, that you do not plan to sell the property and you have to give it to your children, or you do what is called a 1031 exchange. That is, you exchange the property for another one, same value, same characteristics of the property, and you don't have to pay taxes there for the exchange. But at any other time, when you sell the property and you're going to get cash, you have to, first of all, pay capital gains because when you sell the property, you purchase, let's say, 100, and then you're selling at 200. You have a capital gain of 100,000 that is taxable up to 20%. And the depreciation that you took, it's also taxable up to 25%. Those are basically the deadlines, or not the deadlines, the guidelines that you need to follow when you have a depreciation.